Happy Friday, February 24th. What a week, huh? What a week. Tons of data, tons of Fed comments, tons of movement. What a day, what a day, what a day. So, let's start out with Lumineer, LiDAR company that we're talking about. It's interesting today. It finally broke out. Closed at 8.30, which is up 84 cents or 11%. Isn't it funny when you look at the option chain? Yesterday it had 40,000 puts traded in a day. That was just in one strike. 20,000 in three other strikes. Sorry, I'm getting a little interference there. 40,000, 20,000. The day before it had over 100,000 traded in both puts and calls. Today, 8,000, 7,000, 5,000, 1,000 in puts. Things that make you go, Anyways, finally broke out because they didn't manipulate it today. So broke out. The sevens went from 20 cents to $1.30. Thank you. Let's see. What I really want to talk about more is the roller coaster of a day we had. So, just like most days so far, everything's kind of all this movement's not real buyers and real sellers and bulls versus bears. And if you go on Twitter, it's bulls did this, bears did that. I don't really think there's much of that going on at all. I don't think there's perma bears or perma bulls. I think there are just tons of trading going on, and going into like the meme stock era in 2020. I think these big institutions and hedge funds realized that retail was just, I don't want to say manipulating options, but using gamma and delta to kind of create these short squeezes and create movement in a underlying stock like AMC, GameStop, Bed Bath and Beyond, all these like whatever companies, but they're moving the stock a lot just by piling into options. And I think institutions, hedgies, and everybody else has kind of caught on, and now they're doing it. And now they just basically, early in the day, they're buying a ton of puts, selling a ton of calls, and it's getting everything to just tank early. And when they get down to a serious inflection point where a big dump should come, they flip. They monetize all their puts, so cash out, and then start selling puts underneath the price, and then start buying calls. And they're creating these whipsaw days like yesterday and today. Usually it starts with data. Obviously today was PCE this morning. Came in hot. I don't know why everybody thought it wouldn't. 0.6%. They're expecting 0.4%. Not good for rate hikes. The other one we were talking about was the Michigan sentiment. That really, that was another leg down at 9 a.m. So PCA came in hot. Spending was up. Consumer spending was up 1.8%. They're expecting 1.3%. Monthly income down a bit. So that one's interesting. That was 0.6. They're expecting 1% increase. That's interesting. Spending up, income down. That's kind of a break from the norm. And that means that people are borrowing to spend. Usually. Now, one day doesn't make a trend, or 1 month doesn't make a trend, but it starts painting a picture, and at some point the picture turns into a trend. I gotta figure out this headphone thing, sorry. So spending up, income down, inflation up, consumer sentiment is up as well. So consumers are actually optimistic about the economy. The Fed doesn't like any of that. They want the consumer, the demand side of supply and demand, to be weaker. And if they're not doing that, inflation will continue to rise. That's only one of the few prongs that go into inflation. Government spending is obviously a massive one, and the biggest is just printing money out of thin air by the Fed, and they continue to do that to support things that are not supporting the supply side of things, not creating product or at least doing infrastructure or anything like that. They're just kind of throwing it away at these other programs that don't produce anything, that actually just suck more life out of GDP. They're just devaluing the dollar, and when you do that, it takes more dollars to buy the same product. So instead of $5 to buy whatever, it's going to take $6 because the value of your dollar went down. That's real inflation. That's where it's all coming from. So when they see the consumer still optimistic, still spending, that there's no way they're slowing down. No way at all. And what's interesting is we talked about a couple of weeks ago, the market was pricing in 2 rate cuts by the end of the year. That's gone. Finally gone. Now they're expecting another half basis point rise in rates, which seems a little more realistic. The 10-year hit 10%, or not 10%, hit 4% today. Came back down a little bit. I think it closed under, but last time we were at 10%. Last year, the 10-year was at 4%. Stocks were 200 points lower than here. I think S&P was around 3750. What that tells me is there's still a lot of froth in this market, and I think you're kind of seeing it, on these early dumps. It's big traders trading, big institutions do it, but they also take the opportunity to offload some stuff, and then kind of reverse course midday. I mean, at the end of the day, we're down almost 2% in the NASDAQ, a percent in the S&P. I mean, it wasn't a good day at all, but it could have been a lot worse. But if they just take this all to, fair value, if you want to call it that, all in one day, they'll destroy it completely. They'll destroy the market. It'll be like, 3,000 S&P. They'll hit circuit breakers. We'll have halts all over the place. They don't want to do that. They want to keep retail and the less informed hedge funds in the market. That way they can actually unload their shares and slowly march the market down, not just rug pull it and call it a day. So I think that's also going on right now. Let's see. We almost broke that key 39.50 today, and they did what they did last week, where they kind of ticked it under, held it for a bit, but it just wasn't quite pushing. Everybody was already long puts, so expecting the market to go down. And we got down there, we saw a few more big chunks, big lot orders buying puts, and the market just didn't break. Usually that's a sign of a reversal of, all right, now they're a little bit too offsides. They're expecting more downside, but it's just not coming. And that's usually when, things start reversing back up. And that's exactly what happened today. Another interesting note was, I think 4 Fed members spoke today because they like hearing themselves talk. I don't know why they keep doing this, but they continue doing it, and they'll always do it because they're narcissists. They just like to hear themselves talk and read their headlines. But I think Master, I don't even know how to say her name, said that more tightening is required. When that headline hit, S&P dropped about 10 points in a flash. Another headline hit at the same time. And when I don't trust, a common theme for me on this market is it's a casino. It's run by what we were talking about earlier, big funds having their way with the market and manipulating it by, the options. Sometimes this will happen. Stocks were trying to break out at what's the difference? Let's see, give me 1 second, sorry. I look at ES, I don't look at SPX. So SPX is when you look at your phone and stuff, that's what you see. We're trying to break out above 39.80. What I've noticed that when we have if we did that, we would have probably ran back up to 4,000. I noticed, I've seen this countless times, is when we have a reversal day. It's late in the week. Funds are trying to pin these names to a certain price so they can collect premiums in the options. When things get a little out of control for them, where they might have to cover and then kind of exacerbate the move higher because they're short, or lower because they're long. Notice they'll recycle headlines. They do it a lot with Apple. They did 2 months ago. It's so ridiculous. Apple was about to break over, I think 180. It was way higher. It was about to break out, and then there's a report that it was Avago, Broadcom, AVGO, and it was Qualcomm, QCOM. All chips were rallying that day. That's what it was. All chips were rallying that day, led by those two. And then out of nowhere, a headline hit that Apple's bringing their Wi-Fi chips in-house and cutting ties with Broadcom, and then with Qualcomm, and then they said they're bringing their processors or whatever else in-house as well. So they're going to start making their own chips, cutting ties with Broadcom and Qualcomm. Both those stocks were about to break out, and sure enough, they just immediately tanked. They both were down 5% within a second. If you look back right before that, you see a lot of puts bought. Puts meaning they expected to go down. Tons of puts bought right before those headlines hit. The headlines hit. They collect on those, and then those stocks just for the next 3 days, because they just went through such a shock and news, they just got smashed for 3 days. Everybody, it's like a forced liquidation. And then a week later on page 6 of CNBC's, turned out neither of those things were true. So they'll do fake headlines like that, and they'll also do recycled headlines. I think yesterday or 2 days ago, there was a headline saying that China's going to supply kamikaze drones to Russia. This came out, I think, at like 8 p.m. The market didn't react at all. The headline was recycled today when we were trying to break out over that 39.80 mark. Trying to break out. That hit immediately down 10 points on the S&P. It kind of shot right back up, but the damage was done. The shock was there, and then you start getting people exiting because they go, this is a little bit too volatile for me, so I'm getting out. And then just slowly stock sold off. I think 25 points. So when I say this is a casino, it's run by Citadel and BlackRock and all these other mega funds. That's the type of stuff I'm talking about. And once you see it, you can't unsee it. That's why I tell you, have your fun, get in, get out, and move on. Because they will come for you eventually. And they can see our order flow because they buy it. Yeah, okay, sorry. A little too conspiratorial? I don't think so, because it's all accurate. And then the last thing I'll finish up with is if you watch the trading day today, the last hour was just hilarious. So at 1:45, so I always say Apple's a perfect proxy for where the S&P is going, and if you overlay them, they're pretty identical. The sell program comes in around 1:30 and just slowly and meticulously sells Apple, just relentless, from 46.28 all the way down to 45.76. Which right when it was, broke that 146 number, all the other stocks started coming down because then it was like, okay, big boy Apple is, gonna hit the deck here. And right when that happened, sell algo turned off. Big buy candle right from that low of 145.80 or 76. Within 3 minutes, it was 146.20. And within 15 minutes, it was 146.70. All the stocks finally go, okay, well, Apple's going up. So everything else started coming back up. And right when that happened, they dumped at 146.68. 3 minutes later, 146.22. Kind of chopped for a bit and then retested that low of 145.76. And when it did that, all their stocks started coming down. And right when that happened, they popped it again. So in the last, at 2:45, there's a little pop. They dumped it one more time just to spook everybody. And then in the last 9 minutes, this thing went from 145.70 to 146.81. That's the type of manipulation I'm talking about. Those aren't normal moves, and those are created by option flow. It's just ridiculous is what it is, but it's fun if you catch it. But trying to time these things and try to figure out what's going on behind the scenes, it's next to impossible. But it's days like today really put you through the ringer of mental endurance and mental and emotional endurance. All right, I think I've gone too long. This has been way too long, I think. I kind of rambled. Anyways, Friday, next week, let's see. I think we got a pretty quiet week, but we are at a big inflection point in the markets. Again, last time the 10-year was here, we were 200 points lower. But like I kind of mentioned earlier, this market's not really, it doesn't really care about price particularly. People's 401ks are held in stocks. Money managers have their customers in stocks and bonds. There's so many ETFs, and just whoever's in is just holding through all the chaos, and then you got big boys trading it. So I don't really think yet that stocks care. They just don't. I think I mentioned PEs are also just out the door. No one cares right now. That will change. But for now, it's just let's just chop it for a while. Let's just chop it up. I mean, if you look back, we've been in the same range for 6 months. It's a roller coaster, but nothing is broke yet. It could. With rates where they are, they should, but they're not. So, again, I still think stocks are on borrowed time, but I'm not going big on figuring out when. All right, next week, pending home sales. That should be a big one. That's on Monday at 9 a.m. So during trading hours, which is, I always think, better. House price index, Schiller, Chicago PMI. That one's kind of fun. That's on Tuesday. Wednesday are mortgage applications, which usually have zero effect on the intraday market, but there's no chance those are up. I think mortgages are at 7.5% again. And then Wednesday at 7:30 a.m. we have the ISM manufacturing numbers. That's a big one. That'll be a big one. Thursday, jobless claims, non-farm payrolls. That's a big one. And then Friday, we have the big ISM numbers. So, tons more data coming out, and that should give us direction. It should. But it'll probably just push us down to a low extreme and then rally us back up. Because all anybody ever cares about is making money, and however you can do that is what they're going to do. All right, I've gone way too long. Hope you all have a great weekend, and I will catch you on Monday. Okay, I love you. Bye.